Thanks for joining us today in Market Call. I'm Morello Fernandez. Andrey Omelchak with us on the show, CEO, CIO, LionGuard Capital Management. He'll take your questions on North American small and mid caps. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. You can send an email as well, marketcall@bnnbloomberg.ca. Good to see you. Thanks for coming in.
Great to be here.
Big news today with Ottawa and Beijing coming to some sort of agreement to reduce some tariffs, which people were thinking might not happen just yet, but clearly they've come to some sort of understanding. What's your reaction to this?
Well, I think it's a very logical step for a federal government to go to China and other countries as well and to sign those agreements. We have to forge our own path. We have to stand firm on our feet, and we have to make agreements with other countries. And we should not be held hostage to the ongoing negotiations with, a named foreign trade partner.
Okay. That being said, we are still being held hostage with the fact that negotiations have not really moved forward on CUSMA, and we don't know whether that trade agreement will be renewed. How are you seeing a lot of that uncertainty and the other uncertainty that started this year playing out on the market? Yes,
absolutely. So CUSMA negotiations, of course, going to take place further this year. And we never know if they're going to be postponed again or not. And if you read carefully CUSMA, if there is no agreement, it gets extended. So we shall see what happens on that front. But what we're seeing is we're seeing a firm commitment to invest in Canada, to build Canada. And there's a lot of excitement. And I think this is a real investable theme that we can get behind because at some point, real money will start flowing. And I think that this will translate into the operating results of the companies. Yeah, you're talking about Build Canada, of course, the need to put infrastructure into different spots across the country to better trade, for example. What are some of the overall themes you see as investable, and what are the ones that are sort of nearer term versus down the road? Yes, so Build Canada is a big theme, as I just mentioned. I think that's here to stay. And given what's happening on the geopolitics globally, you have seen what happened in Venezuela. You see the rhetoric around Greenland, potentially Panama Canal and Cuba, also on that list. We're back to Monroe Doctrine, if you look at the history and what it means. And the U.S. government has been very active and very clear in communicating what they think their vision for the future is. So dominance of the Western Hemisphere, and the playbook is pretty clear as far as I'm concerned. So in that realm, you have to really invest in the national defense, and you have to invest in domestic priorities, and you have to stand firm so you can maintain the potentially growing pressure over the years to come from the United States of America. So energy, you mentioned defense, construction, all of those things that are interesting for you moving forward? These are all interesting industries. However, I think that Canada should count our blessings. We have immense resources, natural resources, that we should take advantage of. But we should not build a whole economy around natural resources complex. We have to take the proceeds from that, and we have to invest in high technology as well, and aerospace as well. So there are a lot of industries which we have really did not invest over the years, and we need to really activate our whole resource complex, takes the monetary proceeds from that, and invest in high technology, in my opinion. Also, because you look at small and mid caps, what's that been like so far on the year? Last year, they kind of stalled. Well, last year was the market driven by resources complex. Of course, the gold equities have rallied a lot. There's probably been 10 years of waiting for the gold prices to finally rally. It has happened on the back of geopolitics and other dynamics. I think it's anybody's guess where the gold prices are going. And of course, overall, Canadian markets have benefited tremendously from that as well. Also, Canadian banks have done really well last year and carried the benchmarks higher. But it's been a very bipolar market also at the same time because some industries are under pressure. Technology companies, a number of them have really underperformed last year on the back of AI threats. The question mark whether the business model will be challenged or not, and what AI developments mean for those businesses. So it has been a very unique environment last year when some companies have done tremendously well, but others are under pressure quite a bit. Okay, let's take a quick break. We'll line up the first phone calls and emails for Andrey Omelchak of LionGuard Capital Management. Again, he's taking your questions on North American small and mid caps. Here's how to reach us. Back in a moment.
Welcome back to Market Call. Let's start today with an email from Sandy's who says, could I have your thoughts on Well Health Technologies, please? Well Health owns and operates sort of medical clinics, that kind of thing. Is it a company you know well, and what do you think of it?
Yes, I know Well Health quite well. I've been following it for, I think, almost 20 years. It's a good company. I like the CEO quite a bit. Hamed is a great guy. I think it's a great buying opportunity for Well Health actually right now. The sum of the parts valuation provides for a lot of upside from the current stock price. The reason why I like it is because they're divesting non-core operations in the United States right now. They're in the process of doing that.
Do you think they need to do that?
I think they absolutely need to do that. They have not performed too well. It has been a big disruption of their time. And they really need to focus on Canada because in Canada, they can consolidate the clinics. The return on invested capital is very high to invest domestically in those clinics. They have less than 2% market share. There's a tremendous runway for them to consolidate clinics in Canada and to invest here. As they do that, investors are going to get more comfortable about the overall business. They can get their head much more around the financials, which are very messy right now. So you need to divest US operations. There are 3 segments there which they need to sell. They've been very clear to the public markets. They will do that as soon as this year. And they also intend to IPO Wellstar as soon as in the first half of this year. And this is a crown jewel inside the Well Health. And I think it's going to command a very healthy multiple in public markets. So there's a real value unlocking which is about to happen. And I think investors, everybody's waiting for them to sell US assets, to have much cleaner financials, and to start consolidating Canada. And if they do that, they have a potential to become a multi-year compounder and command a much higher multiple in the market.
Okay, let's go to the phone lines then. Jack's on the line in Toronto with a question. Hi, Jack.
Hi, Marilla. Hi, Andrea. How you doing? I have a question regarding Blue Owl Capital. I've been following this stock for quite some time, and I was wanting Andrea's thoughts on what's a good entry point into this stock. Has he been following it, and what he thinks of this stock? Thanks very much.
Go ahead.
I wish I could be more helpful, but I'm not familiar actually with Blue Owl Capital, so I'd rather pass on to the next question.
Okay. Not familiar with the company. Let's go to the next caller. Then Alan's on the line. He's in Barrie, Ontario with a question. Hi, Alan.
Yeah, hello. My question is on Exchange Income Corporation. The stock ticker is EIF. I've been in it for about 3 months, and I'm up pretty good. I was wondering if I should hold on to it or sell it.
Okay, what do you think?
I think you're very safe to hold on to Exchange Income Corporation. They generate healthy dividend yield, which is here to stay. They're exposed to the right thematics, which is defense and Canada North as well. They also have other avenues to improve their operating margin. So it's a good company. They've been around for a while. And now the business is actually growing quite nicely. They also have consolidation opportunity as well. So I expect some accretive M&A from Exchange Income Corporation. And in terms of the fund flow dynamics, there's a lot of capital coming into this company. Everybody's looking to get exposure to the defense theme in Canada. So there's so much capital on the sidelines, and Exchange Income is certainly in that list of the companies where more capital will be coming into.
Yeah, so it's something we talked about at the start of the show with investment in Canada. This is one of the companies that would benefit.
Absolutely, yes.
Okay. All right, let's go to JC. JC's in North Bay, Ontario. Hi, JC.
Hi, I'd like to ask about Lumine. Looking for some stocks that aren't maybe overvalued or at 52-week highs, and the Constellation brands are the only ones that seem to be around the lows. Do you think Lumine's a good buy here for a rebound?
Okay, let's have a look at Lumine. What do you think?
I think it's a tremendous buying opportunity for Lumine Group at these levels. Lumine has sold off together with the other vertical market software businesses across the world, actually. Because the questions around the AI threats, what does it mean to be able to develop software at a fraction of the cost? In reality, Lumine has a very sticky business. If any company going to be challenged by AI, I don't think Lumine is on that list.
Expand on that for me.
Yeah, so if you think about it, vertical market software companies are the ones that have a very integrated operations with the underlying clients. So you really have to get to know the business inside out. You have to be able to address all the special cases. You need to build a trusted relationship with the end clients. And for somebody to come in and to offer a software solution which might address, let's say, 80 to 90% of the business cases at a fraction of the cost, they will not be able to displace an incumbent relationship. It takes many, many years, many iterations of the software to address all the special cases. And if you think about it also, a company like Lumine can actually innovate as a result of those developments at a fraction of the cost. So they're net beneficiaries of that. Also, in Lumine in particular, they just made an acquisition. It's expected to be closed shortly, highly accretive. They paid about 6 times EBITDA for that business. That's before any synergistic benefits. So they're deploying the capital at very high rates of return, which in my books is a 20, 25% plus. So exceptional capital allocation. Of course, Lumine is a spin-off from Constellation Software. And I think it's a tremendous buying opportunity. I think the market's very wrong.
Okay, so you would pick it up here. All right, let's take a quick break. When we come back, we will have more phone calls and emails for Andrey Omelchak of LionGuard Capital Management. Back in a moment. Welcome back. Let's go to an email from Trinity. Trinity says, what does the guest think of the Canadian banks? A few to go through there. What do you think of the banks this year?
I think they're a solid hold, and they've been doing a very good job overall. Loan growth remains pretty healthy, I would say, especially on the commercial side of things. On the residential, they're not doing as well, as you know. Canadian housing market needs to breathe for the time being. Provision for credit losses have been going high a little bit, but nothing too alarming. I think it's a normalization from the prior lows. I think they're doing a pretty good job on expenses, actually. So if you put all this together, I see 10% plus earnings per share growth rate for the banking sector this year and potentially next year as well.
AI efficiencies, will that sort of add to the bottom line for banks this year?
I hope so. I hope so. For the most part, they're taking some efficiencies and they're reinvesting those gains. But whether this is going to translate into actual gains in terms of their financials remains to be seen, I think. But I think what I also like about the banks is they have a high capital ratios. And at the same time, return on equity is trending higher. So overall space is doing much better than in the past. And I think the case can be made that multiples need to expand for Canadian banking industry because of the higher return on equity. And also regulatory environment is getting more favorable. I would not yet put in our cards that OSFI is going to lower the capital requirements for the banks, but it is possible as the red tape overall comes down. Of course, it's happening in the US, and Canada needs to also take note and see what we can do. Are we too stringent on the banking sector? That's a question we need to ask ourselves. Of course, we have been net beneficiaries during the global financial crisis, but I think we need to be cognizant of where those capital ratios need to be to ensure our competitiveness.
Okay. Let's go to the phone lines then. John's on the line in London, Ontario. Hi, John.
Hello, Marilla. Hello, Andrey. Andrey, small caps have done well. I've been riding the beta on a couple, Crack and Zedcor. I wonder if you could comment on MDA Space, which appeared to lose 2 customers, but then maybe it's only 1 customer they lost, and they're on the way back. And the second one is McCoy Global, which is the only small cap that I have that hasn't done well lately. Thanks very much.
Thank you for the question. Let's start with MDA Space.
Yeah, sure. So MDA Space, there's been a lot of volatility. They have lost a big contract. They have regained some other ones. There's been an announcement that came out actually last week. Mm-hmm. They're part of the Golden Dome, so to speak.
But no dollar amount associated with that announcement.
Yeah, we don't know how much it represents. But the fact that they're part of it is clearly a good endorsement from the US government. So I think they're part of that solution. What they need to do, they need to diversify their client base. At the same time, I think the business is doing well. They're free cash flow generating already. I would love for them to generate higher free cash flow yield, but finally they're not burning cash, so that's good news. And as they add more clients, they become more diversified, I think the case can be made that investors will get more comfortable. I think that it's such a mission-critical company, both in Canada and actually, if you look at some of the European companies, they can also become clients of MDA, what they're doing. So, and it's also exposed to the right themes about defense and national security. So I think you should consider MDA as through those lenses, and maybe give them a bit of a break in terms of the near-term free cash flow generation. But I think you can be safe to hold it for the next several years.
He also had a question about McCoy.
Yeah, I'm actually restricted. I cannot comment on McCoy Global, so I'll move on to the next question. Thank you.
Okay. The next question comes from Michael in Montreal. Hi, Michael.
Hi, Marilla. Hi, Andrey. Andrey, would it be possible to have your opinion on Propel Holdings? I know in the past that you recommended, like you liked it at $32. Would you like it even more at the current levels? As well, can you comment on their banking license that they recently received? Thank you very much.
Okay, thank you for the question. Propel Holdings.
Yeah, sure. Propel is a non-prime lender. They charge pretty high interest rates, but at the same time, it's 100% within the regulatory environments where they operate. They generate exceptionally high return on equity. What happened is that they have slowed down the originations at the end of August and September, and then subsequently they started to increase the origination activity. They saw some cracks.
What is the origination activity?
Origination activity, yes.
Can you explain that?
Yeah, the new loans that they have on the books.
Okay.
Because the rotation of the loans is pretty high. These are shorter duration loans, and you need to always grow the loan book. And if you slow down the growth, you could make a case that business might actually shrink. In reality, the business has been growing at almost 40% a year in, year out, because they're just expanding, across US, across UK, and they're looking at other countries as well. They do have also a presence in Canada, although not too big. So
he had mentioned you liked it at 35. Do you like it even more at 23?
I like Propel Holdings. I like management team a lot. I think these are very smart and capable individuals. They're true entrepreneurs. They have built businesses in the past and they sold them successfully. They have their own capital at stake, which I like, so there's a clear alignment of interests. I think that if you buy this company here and you're okay with volatility, I think you're going to do well over time. One caveat I will put to that is there's a clear intervention by US government into various industries, which we have noticed literally in the last several weeks. We're talking about defense industry intervention, maximum salaries you can have, how to allocate the capital.
No buybacks. Yes.
No buybacks, that's right. We're talking about intervention to the housing complex as well. You cannot
Can't own residential homes for families, yes.
That's right, yes. And now we're also talking about potentially regulating the cap on credit cards at 10% maximum rate. So that would be devastating to that industry. So can they come out and regulate potentially non-prime lenders to have a cap on that too? I don't think so. But that's one risk that I think we have that we can really not predict. So I think you have to be careful investing in non-prime lenders overall. But I would say that Propel is probably one of my best ideas in that space, especially given the quality of the management team and the fact that they're expanding not only in the US, but also have a very profitable and fast-growing operation in UK. I also expect them to do accretive acquisitions elsewhere as well. They have proven their business model in UK, and I think they can do the same in other countries. So I think Germany is of interest, maybe Australia is of interest. So it's a very high-quality operation, extremely well run. And I think if you don't have a very big weight in terms of your portfolio, I think you should do well investing in that. So.
Okay. Let's take another quick break. We will move on to past picks from Andrey when we come back. Stay tuned. Time now for past picks from Andrey. These are from April 1st of 2025. At the time, he chose Topicus.com, TOI, on the exchange. It was 143.07 at the time, down to 111.11 right now, so a 22% drop, and total return 22% as well. Is this a company that has suffered from the same software concerns as others?
Yes, absolutely. So Topicus has been a victim of the attack on the vertical market software companies, same as Constellation Software and others. In reality, the business is doing really well. They have a record year of capital deployments last year. They deployed $835 million. I think the pressure on this business is overdone. It generates a 6% plus free cash flow yield if you look at next year. And I think they can reinvest that free cash flow at a 20% plus CAGR going forward. So if you do the discounted free cash flow valuation, there's a tremendous upside for that business if you think it's not broken. Of course, Topicus is focused on the vertical market software M&A on the European market. So we also have to look at organic growth rate opportunity, and it has been okay, actually. So I think you have to watch closely for that inflection point in terms of potential organic growth rate being flat or even accelerating. And I think that's going to give a bit of a breathing room for this business and the confidence to the investors that the business is not being challenged, both the base case business and also on M&A side of things.
Is this something you've held on to?
That's something I have held on to, yes, that's right.
Okay. All right, let's get to your next past pick, Boyd Group, BYD on the TSX. They were at 205.63 in April of last year, now at 224.28, so 9% upside, a total return the same. They run collision or own collision repair centers. A bit of a harder market, I imagine, now because autos are, trading differently and crossing the border differently. But how have they been able to grow, and do you still like them?
Yeah, auto collision repair business has been challenged actually for quite some time. And I think the industry has bottomed now and is doing better. If you look at the results of Boyd, they have done tremendously better than the rest of the industry. Their same-store sales growth rate has turned positive now, so that's a very good indication. And also, if you look at the insurance companies, I think the market is getting much more constructive. So the insurance rates are actually coming down, so that's a good positive. Mm-hmm. And the used car prices are now stable, which helps their business quite a bit. Another thing I like right now is that they're focused on acquisitions, single locations and multi-location acquisitions. And what I'm seeing less competition for those right now in this environment by private equity. And I'm also seeing better multiples that they're able to get. So I think they're going to accelerate their M&A, and it will be quite accretive to their business as well. In the past, and they will continue opening greenfields and brownfield operations as well. And there is a very high return on capital on those, but it takes a bit of time for them to ramp up. At the same time, what they did is they introduced Project 360. This is focused on generating efficiencies in the business, because during tougher times, you have to look for ways to optimize the business.
Easy enough to do for that business model?
Not very easy, but they have been successful. The management team has done a good job. And I think what it does, it creates a lower fixed expense base on which can be leveraged when the business does better. So that will lead to the margin expansion for the business as we're going into the better market environment. One thing I want to caveat with Boyd is that in the past, it was very M&A focused, and I think it's going to accelerate again, but the industry is not as fragmented as it used to be. So in the past, you could really grow the M&A a lot, and now they have a bigger market share, as well as some other big players have significant market share. So the accretion from M&A, you cannot extrapolate that for the next 10, 15 years, as you could 10 years ago, for example. So that bodes the question of what type of multiple this company warrants, and should you assign the same multiple as you did in the past to the accretion element from M&A? So that's the only caveat I would put with Boyd.
Okay, let's get to your third past pick, Constellation Software, CSU on the TSX. And of course, we've seen this drop a lot over the past year. So 4,603 at the time you recommended it, and now to 2,864, 38% drop in return, a 38% total return. Have you held on to Constellation?
Yes, in fact, I bought much more Constellation Software on this drop. I think the drop is absolutely overdone. Right now, it generates more than 8% free cash flow yield if you look at 2027 numbers. And in my opinion, same commentary I did earlier for the Topicus, in that vertical market software businesses actually might actually be net beneficiaries of what is happening with artificial intelligence. Last year was the second highest year of capital deployments for Constellation Software. If you look at the whole ecosystem, they deployed more than $1.7 billion. Of course, they had a change of CEO. So visionary Mark Leonard retired from his CEO role, unfortunately for medical reasons. But the good news is that he's expected full recovery. And Mark Miller took over. Mark Miller was head of the Volatus, which is within the tree structure, one of the biggest companies, actually. And Volatus did the best job on capital deployment. So there are lessons learned from that. What they did is they kept the capital inside the companies, and they've been able to deploy them much better than the rest of Constellation Software. So I think the playbook from Volatus applied to the broader Constellation ecosystem will be net positive. for capital deployments. And something to keep in mind is that they're not standing still. They're talking about artificial intelligence on a daily, if not daily basis, I would say. And they're implementing that across 1,100 plus companies, which they own globally. So I don't think there are issues on capital deployment. Another thing I like is that private equity is not as competitive right now. So they really stepped away because of the fears. So they can do acquisitions much faster. So I expect actually acceleration on capital deployment side this year and potentially next, which will be very accretive to the earnings per share growth rate.
All right, let's take a quick break. We'll line up some more phone calls then for Andrey Omelchak of LionGuard Capital Management. Again, he's taking your question on North American small and mid caps. Back in a moment. Welcome back, and thanks again for joining us. Let's go to Rick on the line in Toronto. He's got a question. Hi, Rick.
Hi. Just wanted to ask Andrey his thoughts on NFI Group, and specifically, I've been building a position for close to a year now on weakness, and obviously it's very volatile. I think it ran up to $20. It's pulled back. It's moved forward. But specifically about their supply chain issues as it relates to accessing batteries. So if he could comment on that, because when I look at the backlog of the company, it's very impressive, and it's going to grow even more as far as I'm concerned. So if he could address specifically the supply chain problem as it relates to the battery issue, I'd appreciate that. Thank you very much.
Okay, can we talk about the supply chain problem?
Yeah, sure. Thank you, Rick, for the question. So NFI had supply chain issues, as you know, on and off. First, there was seats issue. Now it's batteries issue. It's a complex business to run. There is literally thousands of components that need to go into that. If you're missing one of them, you cannot ship the bus. It really, literally, inventory builds up, and you have a working capital issue, and you have a problem to address. So right now, another issue popped up, but I think these issues are transitory. They are really focused on fixing them. I don't have exact timeline on when battery issue will be fixed. As you know, it's a bit of a complicated issue. It's not as simple as some other ones. But I think, if you fast forward into the future, I think you're doing the right thing. You're building the position in a solid business that's here to stay. That's very difficult to displace. You're not going to have another bus manufacturer company suddenly coming up in North America. And this is essential service that is needed. So, of course, we're not talking about electric buses that much anymore as we used to. But the backlog is growing, and at some point, there'll be unleashing of the backlog, and that's going to translate into the much better working capital and profitability of the business.
Okay.
So I think you have to be patient, and over time, these issues will be fixed.
All right. Let's go to our next question, which is in an email from Christina. She says, could I get your guest's opinion on Volatus FLT? Volatus, I'm not familiar. Can you fill me in?
Yes, it's a drone company, Canadian drone company. So what they do is they monitor critical infrastructure. There's also talk about this being a defense play in Canada. This is the company in Canada that's focused on drones. So, of course, we're talking about drones, business booming. They have signed some good contracts, and they have also raised quite a bit of capital on the back of flying share price performance last year on and off. I would say that we still need to see profitability from that company. And therefore, it falls certainly into the more speculative side of category in my books. I think that if those big contracts really come through and you start seeing profitability coming through, then it becomes a really investable company. For the time being, it's very fast in terms of capital coming in, potentially capital coming out. Even though I like thematic a lot, I think you have to be really careful.
Okay. That was for Christina. Let's go to the next caller, Patrick, on the line in Mississauga, Ontario. Hi, Patrick.
Hi. Thanks for taking my call. I'm calling about Docebo. They generate a tremendous amount of free cash flow. There's no debt and they're cashed up. And they generate a very high return on invested capital as a business. Andrey, your thoughts on the business and the valuation? Thank you.
Okay, so this is another software company?
That's right. It's not a software company. They provide learning software solutions to internal employees within the company, as well as external applications. If you have clients, they can explain how to use your product in a very easy to digest way. I think Docebo is a potential takeout candidate at those levels. What you discussed in terms of cash flow generation is very true. At the same time, my concern with Docebo is I'm not sure they have very big barriers to entry. I don't think the moat is as big as you think. A lot of investors think, and I think it's kind of partially reflected in the valuation. Clearly, they have been innovators. They stepped in. They opened up the greenfield opportunity. They have been. They deserve full credit for doing that. But at the same time, I'm not convinced how the business is going to look, 5, 10, 15 years in the future. Speaking about AI disruption, some companies are more prone to AI disruption, and I would probably think Docebo is not as sticky as would be, some of the Constellation software companies. So they're kind of in the middle. And so therefore, you have to be careful around that. But I do think it could be taken out any day, despite that.
Okay, let's get to an email then from Paul. Paul says, hello, can I get your thoughts on Information Services Corp, ISC? The company has recently come under pressure from an activist investor, and the board has launched a strategic review. So your thoughts on Information Services?
My question is, who's going to buy Information Services Corporation? And I'm not sure the list is that long. I do like the business overall. It's highly sticky. It's a quasi-monopoly. Actually, it is monopoly in a number of regions where they operate in Canada. I think the dividend yield is sustainable and here to stay. I just don't see a very high organic growth rate potential. And I'm not sure who's going to come to the table and pay healthy multiple to take over that company. So I have some reservations, but I think you're probably going to be well served to just hold on to it. And if you're looking for the dividend play, I think you should do well to hold on to Information Services.
Okay. We are going to take another quick break then. We'll be back with Andrey and your questions in just a moment. Stay tuned. Welcome back to Market Call. We are going to the phone lines, and Alex in Montreal with a question. Hi, Alex.
Hi. I'd like to ask you about Descartes Systems. Is it a good time to buy? Thank you.
Thank you for the question. It's a good time to buy?
I think so. I think Descartes is a phenomenal company. It's one of the world's biggest and most effective logistics companies. The stock price has been under pressure. I feel like we come back to this AI theme on and on throughout this show, but it has been impacted by threats on vertical market software. Descartes is probably the last company in the list I can think of that would be at risk of some of those disruptions.
Why is that?
It's highly integrated. It's completely mission critical. It's not a big part of the customer's budgets in terms of their expenses. The last thing you want to do is to bring somebody who does not understand the industry inside out. The room for error has to be absolutely zero. And if there's an error, it costs so much. So I don't think there are any risks around artificial intelligence. Quite to the contrary.
Is this a company that could also benefit from AI internally?
Yes, absolutely. They can innovate, introduce new product modules, charge clients for that. They certainly can also benefit in terms of internal efficiencies like everybody else.
Okay.
So Descartes generates pretty good, healthy free cash flow yield. Of course, I'd love to see trade volumes to increase. That's going to help some of the organic growth rate initiatives. But they also have cut costs a lot. They're doing good investments in efficiency. And they're able to improve, to build on that and expand their margins. So I think it's a tremendous buying opportunity over the longer term horizon.
Okay, that was for Descartes. Let's go to Sal in Vancouver with a question. Hi, Sal.
Hi there. Yeah, my question is on WSP Global. A number of these engineering firms like WSP and Stantec have gone up recently. I'm just wondering if now is a good entry point to get into WSP Global, or do you think it's better to wait for a better entry point? Thanks so much.
Okay, go ahead.
They've seen a lot of investments, of course, in infrastructure, and engineering consulting companies are very much needed. And WSP has done an amazing job over the years to both consolidate the industry and showcase good organic growth rate. I'm a big fan of Alexandra, CEO. I think there is much more room for them to keep growing and to keep making accretive acquisitions. I think WSP, I'm very bullish on at these levels, despite the recent comeback in the stock price. Actually, sell-off was unwarranted, in my opinion.
Okay.
And I think it's a great buying opportunity if you have a longer-term horizon.
All right. That was for Sal in Vancouver. Let's go to Robert in Crow's Nest Pass in Alberta. Hi, Robert.
Hello there. I've been watching Vitalhub. Actually, I've been buying it. It's just been dwindling down, and I'm wondering if it's another victim of the AI developments in our world. I'd really appreciate your outlook on this company.
Okay. Vitalhub, tell us a bit about what they do and your outlook then.
Yeah, so Vitalhub consolidates technology solutions for different healthcare clinics in Canada and in the United Kingdom. They have been victim to the Robert's point of sell-off in software. And same comment I made earlier about Descartes, I will make for Vitalhub. I think their solutions are not at risk of artificial intelligence. These are absolutely mission critical, things that are working inside the hospitals and that are saving lives, that are helping doctors to operate more efficiently. And what's happening is that they're integrating a couple of big acquisitions they made last year. One integration has been going great. Another one, it takes a bit of time to get the efficiencies out, but I think they are coming through. And I think they're going to continue making acquisitions. They get highly accretive acquisitions, as a matter of fact. And they also have an IT center in Sri Lanka. So they're able to leverage some of those efficiencies by moving some of those work to Sri Lanka. So I think it's a high-quality multi-year compounder that you can buy and hold for the longer term.
Okay, that was for Robert. Let's move on to an email from Mike. What does your guest today think about Dexterra Group in Toronto, DXT? Dexterra Group.
Yeah, Dexterra is benefiting from Build Canada initiatives. So this is they're exposed to the modular housing units construction. It's a high-quality company. They have optionality to keep making acquisitions, highly accretive acquisitions, and they have been doing that. And as Build Canada initiatives really start to translate across Canada more and more, and in the US to some extent as well, their initiatives, I think the capacity is going to get filled. There's a lot of spare capacity still on modular housing unit complexes, both for Dexterra and for the Black Diamond Group, as a matter of fact. And as they fill this capacity, it's a very high incremental margin business. Industry is quite rational. And so I think you're well positioned to buy both Dexterra and Black Diamond and to hold them in this environment.
Okay. We're going to take a quick break, then we will come back with new top picks from Andrey. That's coming up next. Join us on Monday for Market Call. Christine Poole will be on the show. She's Co-Chief Investment Officer at Davis Ray, and she'll take your questions on North American large caps. If you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. And time now for new top picks from Andrey. We're going to start with Bird Construction, BDT on the TSX. We've been talking throughout the show about beneficiaries of a build-out across Canada, for example. Bird Construction would definitely be one.
Yes, 100%. Bird is exactly directly exposed to Build Canada theme. 100% of their business actually is in Canada. So they stand to benefit tremendously from Build Canada agenda. They have seen a massive pickup in their backlog. Last quarter, they closed $10 billion of backlog. And since then, they announced additional $1.2 billion of backlog on top of that. So backlog is absolutely booming for them, and this is translate into the business. Also, the backlog is coming in at much higher margins than the current business. It's highly visible, highly predictable. This is not a question mark, and therefore margin expansion, high profitability, free cash flow generation, and better actually free cash conversion also is coming for them. Another thing I want to highlight is that it's extremely cheap if you extrapolate and look forward into the 2027 numbers. And I think given the high quality of the business, even multiple expansion is possible for both.
Do you ever worry about the backlog being too big for some of these companies and them not being able to handle the work that they have?
Yes, absolutely. So that's a key question. Do they have enough people to deliver on the backlog? So they have a track record of doing that. Of course, that's a conversation I have with the management team every time I meet them. Do you have enough resources to deliver on that? I believe they do. And they're not going to take something where they cannot deliver because their reputation's on the line.
Okay. So that's Bird Construction. Let's get to your next pick then, which is Dexterra Group. That is on the TSX at TSU. This is an insurance company, essentially. What do you like about them?
It's a specialty insurance company. They have a good presence in Canada, and they're growing aggressively in the United States. It's a specialty insurance company, so surety, corporate insurance, and they also have a good front-end business. I see tremendous growth opportunity for surety and corporate insurance in the United States. It's a high return on equity business. They have been growing their book value per share at a very high rate, and I expect this to continue. Also, I think nobody talks about it, but they're sitting on an excess capital position as well. That makes them an attractive takeout candidate for the larger insurance company. So I think they're in a hot seat to deliver good results. Otherwise, they will have an unsolicited takeout option by somebody. So it's a good, high-quality company, top management team, and very attractive valuation levels.
Who would be the competitors in the space for them? You mentioned they are a good takeout candidate. Who would compete in their own space right now?
Well, in the US, they have a lot of competition. They're just scratching the surface. So different big groups in the US. Also, they operate in the E&S segment. E&S segment dynamics actually are getting better. We're seeing some insurance rates starting to actually come off, so that's good news. But they're scratching the surface in the US, and in Canada they have a pretty good, decent market share, probably around 30% market share in what they do.
Okay. All right, let's get to Electrovaya, which is your next top pick. Electrovaya is ELVA on the TSX, and they do batteries, they do lithium. But if you could explain a little bit more about how big of a company it is and more about what they do.
Electrovaya is a small cap, undiscovered company that trades in Canada and in the US as well. They do lithium-ion batteries. They have the best safety track record in the industry. And also the batteries last a long time. So that's a huge competitive advantage. Their CEO is an exceptional individual, in my opinion. Has a PhD from Cambridge in material sciences. So the good news is this individual, as well as the rest of the team, can speak the language of the end buyers. So they understand the technical specifications needed for the batteries and how to deliver on the needs of those. They're exposed to the high growth industries. So think about warehouse automation. These batteries would fill the robots that move around the warehouses. Also defense industry. They're in live discussions, if you look at the last conference call of the company, with 2 defense contractors to supply batteries to them. Some of them would be drone applications, some would be their on-land applications. Also, what I'm super excited about is the potential for the energy storage business. So they would supply the batteries to data centers. Data centers, so much capital is flowing there, as everybody knows. But what they're forgetting is they're forgetting about the backup power generation. What you need is a high power, high density backup power generation for several hours at a time in case there is a problem. So data center cannot go black, so to speak, cannot go dark. And they are really well positioned to do that. So if that industry takes off, that will be the multi-year industry for them. And they potentially can become 5-10x of the size of the company that they're in today based on the demand for that industry. As it stands today, they're expanding their operations. They have a good presence. They have a plant in Mississauga, Ontario. And they're building a new plant in Jamestown, New York, which will triple their manufacturing capacity. Now, if the data center opportunity comes on, one state in the US can take on 100% of capacity of Jamestown. So we're talking about the massive opportunity from that.
I was going to say, who do they supply to now? Who would be their customers, for example?
Yeah, so right now, for example, Walmart is their customer. Toyota is their customer. Amazon is their customer, I believe, although it's not being discussed in any materials, but if you look carefully, I think
Read between the lines. Okay.
Read between the lines, so to speak. So they work with the world's best customers, the most demanding customers. Some of it is a one-time business, but a lot of it is repeat business. The battery has a useful life, and then you need to replace the battery. Also, what they're doing is they're introducing monitoring capabilities, so they can monitor the battery performance at a distance and charge monthly recurring fee for that. So that can become as much as 10% of the business. So it becomes a recurring revenue business in addition to all this, supply in the batteries business.
Okay, so that is Toronto. Outside of Toronto is where they're primary, but you said they've moved into the U.S. as well. Andrey, got to leave it there. Thank you so much for coming in.
Thank you. That was great.
Have a good weekend, and thank you for joining us today. We will see you back here again on Monday.